like you suggest in your Goldman days. We've talked before about how Wall Street has treated the markets as a game for decades, a game they always seem to win at the expense of pretty much everyone else, including communities in Wyoming and Louisiana and Rhode Island and Ohio and Pennsylvania. SPACs, for instance, draw in companies that want to please Wall Street, sometimes make promises that they can't deliver on. Look at Youngstown, Ohio. There's a lot to unpack with what's happening at Lordstown Motors, whether or not the company is ultimately able to succeed, and I hope it does. It seems clear there were outside investors looking at this not as a long-term investment in a community with a proud manufacturing heritage and a talented workforce, but as a way to make a quick buck with no follow-through. There will always be people, of course, like that, but that doesn't mean we need to encourage risky financial mechanisms to encourage speculation over long-term investment. In a situation like that, when those investors make their money and pull out, companies break promises and workers and community pay the price. What are the risks, Chair Gensler, what are the risks that the SPAC market has highlighted over the last year, and what can we do about it?
I think the special purpose acquisition companies, these blank check companies, the risk are to investors and the disclosure to the investors. I've asked staff to serve up recommendations that we could consider as a commission. But in essence, there's a lot of costs in these. And secondly, they usually have a 2-year fuse. And in that 2-year fuse, they try to go out and buy something. And a lot of the institutional investors, when that happens, sell. It's called a redemption right, and retail investors are often left holding the dilution or the significant cost of the bankers and the promoters. So we're looking at greater disclosures and also looking at if there's inherent conflicts along the way, and then again try to put this out to notice and comment and rulemaking.
Thank you. My last question. It's been 11 years since we passed Dodd-Frank. The rules on executive compensation, as you know, remain unfinished. We've seen executive compensation soar. We've watched executives leave with huge bonuses after presiding over fraud and scamming customers. The phrase golden parachute has become a cliche. It's that commonplace. Why is it important to have strong rules to claw back incentive-based compensation when executives got that compensation by breaking the rules, and why should disclose the relationship, how important it is to disclose the relationship between executive pay and financial performance?
Let me break it in two things. For the SEC, it's important to move forward because this committee and then the whole Congress with the president put it in law, and it's a mandate that we shall follow. I remember being a staffer sitting on the other side for Senator Sarbanes. I know that that's how he felt. But two, in terms of the substance, I think why Congress addressed this and put it into law is that if there's a material misstatement or omission in the financials and those financials need to be restated, then the executives shouldn't benefit. And there was a certain number of years, a look-back period, a clawback period that Congress said, well, then you should give up the performance-based compensation if it was based upon faulty numbers.